Dominic Bokor-Ingram is Senior Portfolio Manager for Emerging Markets at Fiera Capital. He joins me now. Dominic, as an emerging market manager, one thing I did notice researching this is you're not a particular fan of the emerging markets concept in the round. Why is that?
The emerging market concept is fine. I think it's just the way it's defined is sometimes misused. I think is probably the right word. The original reason for going investing in a country that you didn't live in and you didn't know was to try and make a higher return than in the country that you lived in. And this was the excuse, if you like, for going and investing in emerging markets for the last 200 years. What that changed to in the 2000s was going and investing in countries that were not defined by MSCI as developed and therefore were by default emerging, and creating indices that you then invested relative to, which were not the same as investing in a growth opportunity because of the higher growth created in a country other than the one you lived in. So I think the emerging market term has been somewhat misused, and the original reason for why we go there has been somewhat misused.
But if I looked at returns from emerging markets, and obviously that's probably as defined by the likes of the MSCI over the last decade, they have underperformed developed markets quite substantially. So does that mean that people shouldn't bother with emerging markets if you can get good enough stuff at home? Or do we need to have a serious think about what constitutes emerging markets?
I think we have to have a serious think about how we invest in emerging markets. For every one of the last 10 years, the top performing market in the world in any year has been an emerging market. Now, quite probably the bottom performing market has also been an emerging market. Putting countries like as diverse as, say, China and Egypt into the same benchmark, into the same universe, doesn't make any sense. So my way of thinking and our philosophy of emerging markets is, where can we find a higher rate of return than we can in our home market? And let's only invest there and not think about why we need to invest in emerging markets just because there is a benchmark.
Again, we're talking very much in the round, but how developed are emerging markets these days in terms of the amount of information you can get on stocks, trends, local broker coverage, and how does that vary depending on which part of the markets you're in?
Well, it varies massively. You have quite developed emerging markets where the information is very available, where the stock exchanges are very well developed. But the key is really not how developed a country is or a market is, but how mispriced it is. So what we're trying to find is that information arbitrage, if you like, where a country is developing very strongly, where there is a lot of very good quality information, but the market, the broader market or investment universe has failed to realize that change is happening and that growth is happening. And that provides us opportunity for very mispriced securities.
Well, I suppose two elements for that. The first one is, how do you get your hands on that information? I mean, global emerging markets is a vast area. You're based in London. Fiera Capital, it doesn't have the resources, say, of a BlackRock. So how do you, first of all, get the right information in before you make those decisions?
Well, the first is that, and the first part of the investment process is to determine where we want to focus our attention. Now, if you look at emerging markets that have been successful, what we're trying to do is go down that path from being a small emerging market to a large emerging market to a developed market. And in emerging markets, you make money out of the change rather than the absolute. So we think that there are as good opportunities in a country like Saudi Arabia with $40,000 of GDP per capita as there are in Vietnam with $5,000 of GDP per capita. What matters, though, is what is changing and where the growth is within a particular economy, and can we find the right stocks to actually access that growth at the right valuation. So once we have kind of found where we want to focus our attention and we understand what a reform process looks like, economic reform, political reform, stock market reform, cultural reform, all drive economic growth, we then go to the countries ourselves, we travel on and we be on the ground talking to the companies, talking to their peers, talking to their competitors to really understand the domestic environment. The benefit of being in London is that we are not biased by any location that we are in, but we have the freedom and access to travel to wherever we want to. And travel is a huge part of what we do. Between the team, we have about 1,000 company meetings a year, and about 2/3 of those are on the ground in the countries. And we're really trying to determine the difference, if you like, between the perception, which is how a company is valued, and the reality of how we think it should be valued. And that perception reality gap can be huge in a lot of places in the world.
But how important is it to get the country right as part of it? I appreciate you're a stock picker, but if you look at the news, there's points where people might say, for example, they quite like Taiwanese equities, but they don't like Chinese. But if things kick off between China and Taiwan, they're probably both in trouble. But they get valued very differently. So how important is getting the country right and having a sense of the direction of the country before you invest?
Getting the country right from a risk perspective is very important in emerging markets. As I mentioned, you can have the top performing. You will have the top performing market in any year. It will be an emerging market, but also the bottom performing market. And so we use really the top down as a risk measure to try and to exclude any country where we think there is a systemic risk of losing our capital. And where you've lost capital traditionally in emerging markets has been in massive currency depreciations or in instances like capital controls, where you have no access to your money. So if we think that a country is uninvestable from a risk perspective, then we will have zero in that country. And if we have assets in the country, stocks in the country, and a risk event happens or we think is going to happen, we will sell everything in that country. It's very unusual in emerging markets that you will make money buying the best stock in a bad market. When countries go into crisis, it tends to come out through the currency, and if the currency is against you, you will not make money in any stock.
So you mentioned Saudi a little earlier. So what's the story there? Is it slowly transforming from being a country that produces oil to having a large and thriving economy, regardless of what's going on with hydrocarbons?
Yeah, I'll give you some historical evidence as to what might happen in Saudi in the future. So 30 years ago, the Dubai economy was 95% oil, 5% non-oil. The oil ran out, as we know, and Dubai set about transforming its economy. Today, Dubai relies about 5% on oil for its revenues, about 95% on things like tourism, trade, and financial services. There is the same plan in Saudi to transform the economy from a reliance on oil. And this is really from a risk perspective. If you're a country producing one commodity, you're at risk if we find an alternative energy source or the fuel runs out, the energy runs out, which I don't think that'll happen. But there's a realistic chance we find an alternative energy source. And then Saudi Arabia has nothing as a country to offer. So it is effectively a race against time. It doesn't know what the time is to transform the economy away from its reliance on oil. And that is exactly what is happening through the Saudi Vision 2030 plan. And it's probably the biggest transformation I've seen in a country, in a region, since the Berlin Wall fell in '89, in terms of how quickly the economy is changing.
But do you worry there's going to be a massive misallocation of capital? If I look at Saudi, there was talk about this extraordinary sort of city that was going to be built in the desert. There was going to be incredible length, the size of it, and then incredibly interconnected and all sorts. And that's been rather cut back. So how much of this is sort of fluff and for the cameras, and how much of it's real?
It's very real. And you can see that being on the ground in Saudi. If we just take one example on the cultural side, if you go back 6 years, females in Saudi couldn't drive. Today, it's not unusual to get into an Uber at the airport in Riyadh, and you have a female Uber driver. Now, females in the workforce or female participation in the workforce going from 20% to about 40% in the space of 6 or 7 years is very real change. The economic numbers bear that out, but just the cultural changes alone have provided a massive boost to the non-oil parts of the economy.
But when you transfer across from oil to something else, what are the other things that will mean you've got a strong, robust, balanced Saudi economy, regardless of what's happening with the oil price?
Well, for example, there is massive potential for tourism in Saudi Arabia. It has all the elements in terms of beaches and sunshine, etc., and infrastructure that any large tourism industry needs. There is no reason why Saudi Arabia wouldn't be a destination such as Dubai or Spain or Greece previously.
But those are quite low-skilled jobs.
They're quite, indeed. Those are quite low-skilled jobs. But there is a huge alternative energy industry being built in Saudi. What you have to set up effectively is the incentive structure for capital to be allocated towards innovation. Yeah, if you look at the most successful stock market in the world, the US, it's not just that it's a very successful and highly priced stock market, but that incentivizes people at the venture capital level and the risk capital level to go in and set up businesses and take a risk because they can see the exit. And so what Saudi have done very successfully is built a very, very large and very active equity market that is now incentivizing setting up of the kind of technology businesses, etc., that drove the US equity market and drove the NASDAQ market. Saudi also has massive resources, not just of oil, but also of phosphate and of other metals and minerals. And these haven't been exploited to the extent that oil has in the past because they didn't need to be. Mm-hmm. So if you combine the service side of the economy, I mean, there's no reason why Saudi couldn't be a massive financial hub in the world, let alone in the Middle East. It's obviously well placed for trade, tourism, and you combine that with innovation, and you have the capital to actually fund that innovation and to take that risks. There's no reason not to build a very developed economy in the Middle East or in Saudi Arabia.
Just one quick question on this then. Is there any danger of backsliding? I suppose if you look at one critique of country, or one observation about a lot of countries that have got a lot of natural wealth, not least in a place like Africa, is the institutions don't develop because what you've got to do is sit on top of the gold mine, the copper mine, the oil, and that's where the money comes from. So there's not really any need to develop any of the other institutions and the broader economy. And that's saying I wholly agree with that, but that's certainly a critique. What's to stop something similar happening in Saudi? They're giving it a bit of a go, but ultimately they'll fall back on oil, and it's a country that's owned by one family.
Ultimately, it comes down to leadership. I mean, every emerging market, every developed market comes down to leadership. This is why we get so worked up about elections and who the leaders are. You could argue that the best system of leadership for an emerging market that needs to go through significant change is a kind of benevolent dictator. I mean, if you look at one of the most successful countries in the world in terms of where it was and now where it is in terms of GDP per capita is Singapore. Yeah, Singapore was jungle just like the rest of Malaysia and the broader region. Why is Singapore, with no natural resources, that much wealthier? It had the right leader. Mm-hmm. And if you look at probably, I would think what you would choose to be in a country if you were building a country from scratch, given global resources, a country like Zimbabwe or Iran is another good example. You know, the best combination of culture, resources, agriculture, everything you need to build a great country. The difference between being successful and not is leadership. So that is what is standing. But and this is I'm not saying that in 40 years' time Saudi will be the most successful country in the world. I'm saying right now the rate of change and the transformation that's going on is creating a huge growth opportunity in the non-oil economy. One of the things that we are very wary of in emerging markets is liquidity and capacity. You know, we always have capacity constraints on all of our products because we know that things don't always work out in a straight line. Yeah, Singapore has been a straight line pretty much for the last 80 or 90 years. But there are many countries like Iran, like Zimbabwe, like Argentina, where that straight line has not existed, and therefore we've had to retain the ability to change our minds. And that is absolutely key from a top-down and bottom-up perspective, that we always have to go in with what we think is happening today, and is that the right direction, but with the view that everything on an emerging market journey is tenuous.
You mentioned Vietnam as well a little earlier. So could you talk us through what do you like about Vietnam? And again, what are the longer-term risks? Because if I took the skeptical line, I said, well, they're run by a communist party. Everybody seemed to like China a lot until they suddenly got a little bit scared of it and realized that it was an up-and-coming power, and maybe they saw the world a little bit differently from Western capitalists. Might not a similar story play out down the line in Vietnam on a 5 or 10 year view?
Yeah, I mean, I don't think a bad story has played out in China. I think if you look on a 30-year view, the Chinese Communist Party has taken more people out of poverty than any political party in history.
Yeah, but that doesn't necessarily mean you're going to get great equity returns.
It doesn't mean you're going to get great equity returns. It doesn't mean you even necessarily want to live there. But the evidence of the economic growth in China, Vietnam is a very similar story, I would agree, to China. It just has happened with about a 15-year delay for historic reasons. So the march towards state-sponsored capitalism, which is effectively the model in China, started in the early 2000s in Vietnam and is going down a very similar path. Now, as you rightly point out, the key is, can you make money out of equities there? And the answer is yes sometimes and no sometimes. And it requires buying the right stocks again at the right valuations. So I'll just give you one example of how, if you like, we predict how Vietnam is going to go and how we value equities and how we look at equities according to what has happened historically. If you go back to 1989 in China, formal retail, i.e. shops, was about 5% of total retail. Today it's about 75-80%. If you go back to 2014 in Vietnam, formal retail was 5%. Today it's about 25%. So we know we have this runway in Vietnam under the same political regime, effectively, as you say, in China. The formal retail is going to 80% of total retail. Can we find managers, companies with managers who can take advantage of that very clear runway of not just economic growth? Vietnamese GDP is probably going to expand by about 7% a year over the next 10 years, but also an increase in the actual size of the formal retail market. And then with good management on top of that, you can find companies for the last 10 years and probably for the next 10 years that can compound their earnings by 20% a year in hard currency. Now, if we're buying those kind of stocks at 12 or 13 times valuation, that gives us a massive growth advantage over pretty much everything else that is out there that you can buy in equities globally, and a massive valuation discount. As long as we are, first of all, stick to our valuation discipline and make sure that when these stocks trade at 30 times earnings, we don't own them. But as long as that growth trajectory continues, we're going to make more money in Vietnamese retailers than we are in virtually any other retailers on the planet.
But if someone says to you, that's great, but essentially what you're describing is investing in the next Tesco around the other side of the world and with a higher GDP growth rate, why not invest in AI in the States? I mean, you said the challenge is, why should I take my money from the markets, the developed markets we're in, and put it to work overseas? Aren't there more exciting growth opportunities actually in the rewiring of existing developed economies?
There are definitely exciting growth opportunities in domestic economies. The question always is, there are going to be winners and losers.
Yeah.
So there are 20 people trying to build the next Tesco in Vietnam. We have the experience of understanding how Tesco's have been built in previous emerging markets and understanding what management traits are required, and how to monitor whether these company policies are being properly implemented to understand who will be the winner. Our expertise is in finding domestic growth stories in emerging markets and understand how they develop and how they work and making money in that over time. Someone else has the expertise in finding out which is going to be the next successful AI company, which is going to be the dominant language, large language model. Could be one of 10, 20, 30, who knows? Not everyone picked Google as the search engine that would ultimately dominate.
And a final question, Dominic. Back in the 90s, when the Cold War, when the Berlin Wall came down, there was a lot of excitement about Central and Eastern Europe as going to be crucial parts of emerging markets. That story went rather quiet a few years after that. What's the state of play today? Do you see many opportunities there?
We do indeed. I mean, Poland has been one of the most successful emerging markets of the last 30 years. It's historically, until really the outbreak of the Russia-Ukraine war, Poland was one of the most highly valued emerging markets globally, mainly due to its very well-run and functioning domestic pension fund system. The two markets that kind of had the best pension fund systems, where there was a constant demand for equities, were Poland and Chile. And Chile allowed people to take money out during COVID of the pension fund system, and that reversed the flow of money, and they devalued their equity market. And Poland, unfortunately, has been hit by the secondary effects from the war in Ukraine. But there's no question, we don't have a question that domestic policies in Poland and the innovation that's being created. I mean, I think Poland has the largest computer gaming industry in Europe, for example, is driving Polish economic growth right at the top end of European growth. There are still headwinds in terms of energy prices and their reliance to some extent for trade on countries around them that are struggling with energy prices. But and we see that spreading. And Poland has created the best equity market opportunities. We wish there were more access to those kind of companies in other Eastern European countries. There are specific examples in each of the countries, but there's no equity culture really like they've developed in Poland.
And what, in terms of Poland, I mean, obviously to develop things like gaming industry, you've got to have a lot of domestic talent and keep it there. But when a lot of these countries joined the EU, one of the things that happened was a big flow of populations out. I think places like Bulgaria and Romania, a lot of people moved out. What did the Poles do that brought the talent back home to build those markets?
Well, I think they just put in place sensible policies. I mean, the attraction needed to be greater than moving over to places like the UK and sending money home. So I think it's a combination of solid domestic policies that have created economic growth and some pretty unattractive policies for Polish people, Bulgarians, Romanians, people from the EU to come and work and live in places like the UK. I think it's been an element of both.
Final question, Dominic. We're talking tail end of 2024. We said at the start that it had been a disappointing decade for emerging markets in the round. Is now a good time to be looking at this asset class?
Yeah, I think there's always a good time to look at the asset class because it's not an asset class, it's a series of opportunities, and there are always good opportunities. I would say from an overall perspective that there are a couple of things that are unique in the last today that haven't been around for the last 30 years of emerging market investing. One is that debt levels in emerging markets are lower than they are in developed markets. And the second is inflation is lower in emerging markets than it is in developed markets. And the key importance of those two factors is that I don't think you're going to have the currency headwind that you've always had in emerging markets, where an element of your upside or your earnings growth has always been eroded by the fact that you're in a higher inflationary environment. So that for me is the key change that really is different this time.
We have to leave it there. Dominic Bokor-Ingram, thank you.
Thank you very much.